Which investment creates more wealth? Real estate or index funds? If I gave two people $100,000 today and told them they couldn't touch the money for the next 30 years, one buys rental properties, the other invests in an S&P 500 index fund, who do you think ends up richer? Most people immediately say real estate. After all, that's how many millionaires build their wealth. But what if I told you that a simple index fund has beaten many real estate investors over the long run? And what if I also told you that real estate has a secret advantage that stocks simply can't match? The truth is that both sides are missing something important, because this isn't just a battle between stocks and houses. It's a battle between two completely different wealth-building machines. One is passive, one is active. One offers simplicity, the other offers leverage. And understanding the difference could save you years of costly mistakes. So in this video, we're going to compare index funds and real estate side by side. We'll look at returns, risk, cash flow, leverage, liquidity, and most importantly, which investment actually builds more wealth over the long term. But before we begin, I want to make one thing clear. This is not financial advice. The goal is simply to understand how these investments work so you can make better decisions for yourself. Let's start with index funds. An index fund is one of the simplest investments ever created. Instead of trying to find the next Apple or Nvidia before everyone else, an index fund simply buys a large collection of companies and tracks a market index. For example, the S&P 500 tracks 500 of the largest companies in America. When you buy an S&P 500 index fund, you're automatically buying tiny pieces of companies like Apple, Microsoft, Amazon, Google, Meta, and hundreds of others. Think of it like this. Imagine you're trying to predict which student in a school will become the most successful in 20 years. That's difficult. But what if you could simply invest in the entire graduating class? That's basically what an index fund does. Instead of betting on one company, you're betting on the economy as a whole. And historically, that's worked incredibly well. Over long periods, the S&P 500 has returned around 10% annually on average. Not every year. Some years are fantastic, some years are terrible. But over decades, the overall trend has been surprisingly consistent. This is why investors like Warren Buffett repeatedly recommend index funds for most people. In fact, Buffett once said that after he passes away, most of the money he leaves to his family should be invested in a low-cost S&P 500 index fund. That's how much confidence he has in this simple strategy. But now let's look at the other side of the debate, real estate. Unlike stocks, real estate is physical. You can see it, touch it, walk through it. Many people find that comforting. After all, a house feels more real than numbers on a screen. And for generations, real estate has been one of the most popular ways to build wealth. But the biggest advantage of real estate isn't the property itself, it's leverage. Let me explain. Imagine you want to buy a $500,000 rental property. Most people don't need $500,000 sitting in their bank account. Instead, they put down maybe 20%. That's $100,000. The bank lends them the remaining $400,000. Now here's where things get interesting. You've only invested $100,000 of your own money, but you're benefiting from the appreciation of a $500,000 asset.
And that's something index funds generally can't offer. This is one of the biggest reasons real estate has created so many millionaires. Leverage magnifies gains. But before you get too excited, leverage also magnifies losses. Let's imagine that same property falls in value by 20%. The property drops from $500,000 to $400,000. That's a loss of $100,000. In other words, your entire original investment is gone. The same tool that can accelerate wealth can also destroy it, and that's something many new investors underestimate. Now let's compare returns. This is where things become surprisingly controversial. Most people assume real estate produces higher returns than stocks, but historically, that's often not true. The US stock market has generated roughly 10% annual returns over long periods. Residential real estate appreciation has generally been closer to 3 to 5% annually. At first glance, stocks seem like the clear winner. But here's the catch. Remember leverage? A 5% gain on a heavily leveraged property can sometimes outperform a 10% gain in stocks. That's why comparing these investments isn't as simple as looking at percentages. You have to consider how they're being used. And this brings us to one of the strongest arguments for real estate. cash flow.
Imagine owning a rental property. Every month, your tenants pay rent. Part of that rent covers expenses, part covers the mortgage, and whatever remains becomes cash flow. That's real money landing in your account every month. Many investors love this because it creates income while they continue owning the asset. It's like owning a machine that pays you every month. Index funds work differently. Some pay dividends, but most of the growth comes from appreciation rather than monthly income. If you want to generate cash from an index fund, you usually need to sell shares. So if your goal is immediate income, real estate often has an advantage. But there is another side to that story, because rental properties don't just generate income, they also generate problems. A tenant might stop paying rent, the roof might start leaking, the air conditioning might break in the middle of summer, the plumbing might fail, property taxes might increase, insurance costs might rise. And suddenly that passive income doesn't feel very passive anymore. Real estate is often closer to running a business than owning an investment.
Meanwhile, index funds require almost no maintenance. You don't receive calls at midnight, you don't deal with contractors, you don't search for tenants. You simply invest and continue with your life. For many people, that simplicity is incredibly valuable. Now let's talk about risk, because both investments carry risk. Just different kinds. Most people see stock market volatility every day. When stocks drop 10%, everyone knows. News channels talk about it. Social media explodes. Investors panic. But real estate prices don't update every second. That creates the illusion that real estate is safer. The reality is different. Property values can decline too. The 2008 financial crisis proved that. Millions of homeowners watched property values collapse. Some lost their homes. Others found themselves owing more than the property was worth. The lesson is simple. Neither investment is risk-free.
Stocks experience visible volatility. Real estate experiences slower but sometimes equally painful declines. Now, let's discuss liquidity. Imagine you suddenly need $20,000. If you own index funds, you can usually sell part of your investment within seconds during market hours. The process is simple, fast, efficient. Now imagine you need that same money from a rental property. You can't sell a bathroom, you can't sell half a garage. You usually need to refinance, take a loan, or sell the entire property. And that process can take weeks or even months. This is one of the biggest advantages of index funds. Flexibility. You can invest small amounts, withdraw small amounts, and adjust your portfolio whenever necessary. Real estate simply doesn't offer the same level of flexibility. Another important factor is diversification. Let's imagine you have $100,000. With an index fund, that money can be spread across 500 companies instantly. Different industries, different business models. Can you stay invested during a stock market crash? Can you handle difficult tenants? Can you manage vacancies? Can you continue investing when everyone around you is panicking? Because wealth isn't built during good years. It's built by surviving the bad ones. And that's exactly why many wealthy investors eventually own both. They use index funds for simplicity, diversification, and long-term growth. And they use real estate for leverage, cash flow, and additional wealth creation. Instead of treating them as competitors, they treat them as teammates. Each serves a different purpose. Each solves a different problem. And together, they can create a powerful wealth-building strategy. So, which investment builds more wealth? For some people, it will be index funds. For others, it will be real estate. But history suggests that the biggest factor isn't choosing the perfect investment. It's staying consistent long enough for compounding to work. Because wealth isn't usually created by one brilliant decision. It's created by hundreds of good decisions repeated year after year. And successful index fund investors understand. At the end of the day, the best investment isn't necessarily the one with the highest return. It's the one you can stick with for decades, because time is often more powerful than talent, and consistency is often more powerful than strategy. If you found this video helpful, make sure to like the video and subscribe for more investing and personal finance content. Thanks for watching, and I'll see you in the next one.